All right, let's jump straight into this explainer. Today, we're putting Keysight Technologies through the absolute ultimate valuation gauntlet to see if its massive premium price tag is actually justified. Now, I'm putting on my expert investment analyst hat for this one. We've got a fascinating company here with some genuinely incredible technology, but you know as well as I do, as analysts, we can't afford to just fall in love with the tech. We've got to run the hard numbers.
So we're going to see exactly how absolute legends of the game, like Warren Buffett, Peter Lynch, and Benjamin Graham, would grade this market leader based on their famously strict frameworks. And then we'll pressure test it against modern discounted cash flow models to get a really complete 360-degree view of its true intrinsic value.
Here is our gauntlet map for today. We'll kick things off with a quick company snapshot, apply the lenses of Buffett, Lynch, and Graham, run some modern math, and then synthesize the whole thing for our final verdict.
Okay, Section 1, the company snapshot. Let's see who's stepping into the ring.
Keysight is a heavyweight in test and measurement equipment, especially for AI and 5G tech. Trading under the ticker Keys, it's currently sitting at about $318 a share, giving it a massive $56 billion market cap, but man, look at that hefty PE ratio, almost 54. You are basically paying $54 for every single dollar of current earnings. Throw in a PEG ratio of 1.79, and right off the bat, that multiple tells us the market has already priced in a whole lot of flawless future success.
Now, to be fair, this revenue chart brilliantly illustrates why the market is so excited. Their underlying business momentum is real. Overall, Q2 revenue hit a record $1.72 billion, with their Electronic Industrial Solutions Group steadily climbing up to $486 million. The business itself is fundamentally thriving, heavily buoyed by the broader semiconductor boom. But, as we all know, a great business isn't automatically a great stock.
Moving on to Section 2, we're looking through the Warren Buffett lens, hunting for moats and consistent owner earnings. Honestly, Buffett would absolutely love the raw fundamentals here. They've dug a powerful duopoly moat, basically sharing market leadership with just one other company. Their debt to equity is beautifully low at 0.29, meaning they aren't carrying dangerous leverage. They boast a stellar 21% return on equity, and their owner earnings are spectacular. I mean, they generated a record $472 million in free cash flow in Q2 alone. Qualitatively, this is pretty much a Buffett dream.
But then we actually do the math, and it tells a wildly different story. Even if we assume a super generous 15 times multiple on their annualized free cash flow to factor in a strict requirement for a margin of safety, Buffett's buy price sits way down around $185. That is miles below the current market price of $318. So yes, the moat is incredibly wide. Management is clearly delivering, but the current price offers literally zero margin of safety for the Oracle of Omaha.
All right, Section 3. Let's swap out the glasses and look to the Peter Lynch lens, focusing on growth metrics and insider behavior.
Now this is where things get a bit spicy. Look at those yellow flags popping up. Lynch strongly prefers low institutional ownership to find hidden gems, but Keysight is sitting at 84%. The big Wall Street money is already elbow deep in this trade. Worse still, insiders, including the CEO, have sold nearly $2 million in stock over the last 3 months, and we're seeing exactly zero insider buying. Sure, he'd categorize them as a fast-growing stalwart with a solid balance sheet, but that PEG ratio of 1.79 completely fails his core growth at a reasonable price mandate.
Because Lynch generally wants a PEG ratio closer to 1.0 rather than Keysight's lofty 1.79, his fair value estimate would theoretically land right around $178. If you scale back the valuation to actually match its real earnings growth rate, the math simply does not support a price tag anywhere near $300. For Lynch, this would likely be a hold if you'd been lucky enough to get in early, but absolutely not a buy today.
Let's move on to Section 4, the Graham lens. Time for some old-school, unforgiving value investing.
Okay, let's be real, Benjamin Graham might actually faint looking at a 54 PE multiple, and the complete lack of a dividend instantly fails his rigid defensive investor tests. While Keysight easily clears his hurdles for adequate size and earning stability, the data confirms they pay absolutely zero dividends. Graham demanded a moderate PE and a tangible return of capital to the shareholder. He is not getting either here.
Because the source data didn't hand us the book value per share, we're assuming a fairly conservative $40 book value to run his famous intrinsic value formula against their projected $9.03 in annual earnings per share. In case you need a refresher, his formula essentially multiplies a baseline constant of 22.5 by the earnings, then by the book value, and then takes the square root of the whole shebang.
And the result? A deep value investor like Graham wouldn't touch this stock anywhere near 318. His required margin of safety demands a price closer to 90 bucks. Now obviously, Graham's methodology is incredibly punishing to modern asset-light technology companies, but it serves as a pretty stark reminder of just how far today's market prices can detach from conservative, hard asset valuations.
Section 5. Let's fast forward to modern math, looking at DCF models and comparable multiples. Let's build a baseline discounted cash flow. Using their incredible $472 million Q2 cash flow, we'll make a standard assumption of a 10% weighted average cost of capital, basically our required rate of return, and a 3% terminal growth rate. Even with those solid inputs, our fair value tops out at just $220. Let's say we get highly optimistic. We lower our discount rate to 9% and boost terminal growth to 4%. The absolute highest price we can justify mathematically is still only $285. That current price of $318 simply cannot be reached without assuming unrealistic perpetual hypergrowth.
We also can't run a dividend discount model since, as we know, they pay no dividends. And any comparable PE analysis basically just confirms that 54 times earnings is a massive premium. For an industrial tech stock, historical sector averages normally sit between 15 and 25 times earnings. Shelling out a 54 multiple implies you're paying for more than a decade of absolutely flawless execution all up front.
All right, Section 6. It is time to bring it all together for our synthesis and final verdict.
The scorecard here tells the whole story, doesn't it? While the company itself is fundamentally outstanding, every single valuation model we ran says Keysight is severely overpriced today. Our most optimistic DCF gave us the highest value at $285. Buffett came in at $185, Lynch right there at $178, and Graham all the way down at $90. Yet the stock is currently trading up near $318.
Despite the stellar earnings beat, the sheer weight of the valuation, combined with that insider selling, means this requires real caution. The strengths are undeniable, for sure. They are literally the toll bridge for AI and 5G testing. But the risks are entirely based on price. When institutions already own 84% of a stock and the insiders are cashing out, paying a massive premium is incredibly dangerous. So as an analyst, my final verdict at this price level is a hard hold if you already own it, and a sell if you're looking to reallocate capital to something with better intrinsic value.
I'll leave you with this final, somewhat provocative thought to chew on. Are today's modern tech moats just so incredibly bulletproof that the old rules of guys like Graham and Buffett literally no longer apply? Or is financial gravity eventually going to pull this stock back down to earth? Thank you for walking through this explainer with me today. Keep your analysis sharp, and remember, always keep those margins of safety wide.